Nothing in this video should be taken as financial advice. I'm not a financial advisor. I'm not qualified to be a financial advisor. This is my speculation. This is my thoughts. And this is just opinion only. The Lighthouse Report is sponsored by Hedera. So there is a bias towards Hedera.
So what seemed like last week, it was just the central bank trying to put some order after the prime minister went in there, when in fact this is really the culmination of months of volatility in gilts and in the UK, but in sovereign debt around the world. We talk all the time on this show about the most liquid asset classes, but those that are the most levered. So again, you want to talk about too big to fail. I mean, UK pension funds effectively are that to the UK. Nothing like your central bank governor basically calling out to the world that you're scrambling and you're trying to sell positions that you have margin calls on. Not so good. And it doesn't get better from here. And again, we're now using those acronyms again. Yeah. CLOs. We're talking about the collateralized leverage obligation market, which is $1 trillion in size. And today was a very big headline. And on some level, a new leg to this journey that we've been in with markets over the last.
Hi, everyone. Welcome to the Lighthouse Report. I wrote my piece on the Bank of England pivoting and moving to printing money. They had to bail out pension funds. And what happened was their bond market started selling off. So their debt market started selling off. Now, their bond market is called a gilt, but I'm going to refer to it as bonds. And as you can see with the chart, there is this precipitous drop with bonds, right? And yields have an inverse relationship with bonds. Now, I could buy a 10-year bond and I can hold it till the end of the 10 years and collect the coupon, whatever the percentage it was when I bought it. But I could trade these before the 10 years up, and that's what we're seeing with the chart. So banks, financial institutions, everybody needs these as collateral. So these are considered like safe liquid assets, safe high quality liquid assets. It's HQLA, and it's a requirement for collateral to borrow, right? So these pension funds, what they were doing was they were borrowing against what they had in safe liquid assets, and then asset prices dropped, which made them have to sell their bonds to pay for their loans. So if they took out a loan out of $600 million and their stocks and everything's worth $400 million, and they're going to have to pay more money to make up for that loan. So their collateral requirements become higher and higher. And if they're losing, they have to sell their high quality liquid assets in order to make those margin calls. And what happened was everything happened at once, and all these pension funds had to actually sell. And it was already a soft market, and there's obviously more sellers than buyers, because why would you want to hold on to a 10-year bond when CPI inflation is at 10% and they're offering you 3 or 4%, right? So the bond market was already soft due to that fact, and now all these collateral requirements came up and they had to sell their bonds, and this caused this drop. And they were inches away from insolvency, and these are pension funds. They're supposed to be doing stuff safe with your money, right? You put in a percentage of your paycheck each week to your pension fund with the hopes that when you retire, you'll be able to have some money for retirement. And they have a fiduciary responsibility to make sure that, they're not investing in speculative assets. Now, with that being said, look at the bond market. It came straight down. This is what they call safe quality liquid assets, and you can see this is crypto. Look at the resemblance in the crypto chart compared to what's going on in the 10-year gilt, right? So just this drop from all the way to where it was here to this wick right here, it's like a 32% drop. And on the 20-year note, it is even more extreme. Unfortunately, TradingView doesn't have the 20-year note, but it was pretty much the same drop that Bitcoin had. And these are supposed to be high quality liquid assets. Now, CNBC is brushing this off and saying it's temporary measures, right? It's only supposed to be for 2 weeks, and they're still going to tighten and try to fight inflation. Well, here's the problem, is that if everyone's retirement goes away, there's going to be panic, right? There's going to be panics on Wall Street. There's going to be panics everywhere, right? And that's going to spread like wildfire. So They say that they took extraordinary measures and they'll buy gilts at whatever scale is necessary, but only for 2 weeks. So this is a 2-week purchase program. I have my doubts that it's going to last 2 weeks, but we'll keep an eye out on it. And it potentially could mean that the central banks are pivoting because, all of these banks are interconnected. All of their leverage is leverage with other banks all over the globe, and they're very interconnected. So these LDIs, which are liability-driven investment funds, are owned by the final salary pension plans, which are falling into insolvencies as LDIs were more focused to sell more gilts and turning down prices, and then, selling into the soft market just caused a spiral effect where the Bank of England actually had to step in. Now, the UK is one of the largest economies. Anytime a large economy has turbulence, it's going to send shockwaves through the rest of the global economy. And what's going to put a bottom in all markets is when the central banks start printing again. This is tightening, and you can see it's causing all of this panic. This whole system runs on perpetual debt, and all of a sudden the faucet got turned off. So the Bank of England slowly turning it on. Let's keep an eye out on it, and I think we'll see what happens. But I think this could either spread, and then you're going to see other central banks start to react the same way the Bank of England did. Now, on September 23rd, what happened was there was this large bill that was passed, spending bill, that was going to make up with high energy costs as well as high inflation. And they're going to pass this bill and also increase and lower taxes for different brackets in the UK. And you can see right here, this is when the bill passed. So when there's a large spending bill, the bond market sold off. So this is constraining fiscal policy. So the governments can't spend as much money because the markets are reacting. But that's not going to stop the governments. The governments of the world are spending beyond their means, and they're continuously doing that, and that's happening in the U.S. too. So it wouldn't surprise me to see, once one of these bills pass that has a large spending, a large debt in the bill, we'll see something similar in the U.S. and in other nations. And this drop right here was when the UK passed their bill.
Below a certain threshold or go above a certain threshold. And I think really what's been holding markets up somewhat and have kept people from absolutely running from the doors is this notion that there is not financial contagion. This time is different. And everyone has said, this is what's different. Well, I'll tell you, if you see volatility in sovereigns, that is the underlying pricing mechanism for every other financial assets, whether it be mortgages or credit or whatever else, or even if you're looking at equities, you're definitely going to look at equities vis-a-vis what you can get in risk-free. And so the next point is, who is the next buyer aside from pensions? That is, aside from the central bank, that is one of the largest buyers of index type of security. So, I will understand the BFE saying this has to be a temporary intervention because you don't want you don't want it to appear that markets are being manipulated. But I would argue that fiscal policy, rather monetary policy for the last decade has been kind of put where we want it to be. So